Okay, great. I'm Sarah Hallberg, Interim Financial Aid Officer, the GSAS Office of Financial Aid. And on behalf of the Office of Financial Aid and the Graduate Student Council, I'd like to welcome you to today's tax presentation. This session is specifically for U.S. citizens and permanent residents, also known as U.S. tax residents. So if you are an international student, we had a session last week specifically for international students that will be available soon on GSAS YouTube. If you have any questions during the presentation, please feel free to put them in the chat. The chat will be monitored and there will be time at the end of the presentation to address your questions. Before we start, let's quickly review the information on your screen. The information in this presentation is for general informational purposes only and should not be considered legal advice or personal tax advice. The federal and state income tax rules and requirements are complex and vary based on an individual's personal tax situation. Individuals should refer to the form instructions, tax publications, and information available on the Internal Revenue Service and Massachusetts Department of Revenue Services websites and/or consult with a personal tax advisor. Filing accurate federal and state individual income tax returns is the personal responsibility of each student. And with that out of the way, I would like to introduce Bob Underwood, CPA, who will be guiding us through this tax presentation.
Thank you, Sarah. I thank you and I appreciate the opportunity to participate in this presentation, and hopefully after we're through with the presentation and the Q&A, hopefully all of your questions will be answered. If that's not in fact the case, and I've experienced it on many occasions in the past, questions come up after the presentation that you didn't think of during the presentation, so feel free. I've left my email address on this front screen here, and feel free to send me an email with your questions, and I will get back to you promptly, and hopefully we'll be able to answer your question in a timely fashion. We are running a little late, so to speak, in terms of this presentation. I would hope that most of you, if you've needed to file a return, would have by now, but basically the due date for filing your federal and state income tax return is April 18th, and that's right around the corner. So I suggest you begin the process, and obviously if you have any questions during the process, certainly feel free to reach out to either myself, a friend, whoever can help you. Hopefully you'll get the right answer and you'll be able to prepare a complete and accurate return. So having said that, let's move on to the first slide, which basically is just identifying what we'll be doing here today in terms of the presentation. We'll talk about filing requirements, reportable income, tax forms, estimated income taxes that you may need to pay, any tax credits that might be available, student loan interest, state income taxes, and then we'll get to our Q&A. Now, for many of you, I suspect you may have already possibly filed an income tax return. If not, basically, in terms of what your responsibility is, the system, it's a voluntary system, and you need to report whatever income you've earned and pay the appropriate tax on that income that you've earned during any given calendar year. Maybe for many of you, you've had part-time jobs, and it's possible that as a result of having that part-time job, you may have filed an income tax return, maybe had no tax liability, but filed a return so that you could get a refund of possibly some taxes that may have been taken out of your pay. In any event, your responsibility is to file if your income exceeds a certain threshold, which we'll talk about momentarily, and report that income and pay the income tax on that income. Basically, there's two jurisdictions in terms of who you have to file a return at a minimum. There is the federal income tax system, which is managed by the Internal Revenue Service. And then if you're a resident, whether it be of Massachusetts or any other state, you may have some state filing requirements with that particular state. Typically, in terms of your filing requirements to any given state, the state returns, for the most part, there are exceptions, for the most part, are really a spin-off of your federal return. So typically in preparing your required returns, you will first set out to prepare your federal income tax return. And then in most instances, the state return is a spin-off of the federal return. We are well beyond the good old days of preparing income tax returns manually, and basically there are a number of tax programs out there, software applications out there that you can use. The most prominent these days is TurboTax. There is also an H&R Block online service. There's another service known as TaxAct, and I'm sure many more. But those are generally the more popular ones that you'll probably be using. And again, the TurboTax is a very good product to use, whether it be TurboTax or H&R Block or any of the others. They're all typically menu driven. So basically, as they say, what you enter into the computer, if it's good, you're going to get a good result. If you don't enter in accurate information, you're not necessarily going to get you may get a good result, but it may not be an accurate return. So pay attention to the process. It can be somewhat tedious. You might get to a point where you may have a question with regard to how you need to respond. Don't just respond without maybe understanding the question fully. And if need be, again, you could reach out to me or anyone else to sort of clarify what your response may need to be. But for the most part, again, the software is written and designed to get someone who's unfamiliar with the tax system through the process successfully. So, feel comfortable with it, but just be aware of the fact that you need to pay close attention to what you're being asked of when entering the data into the software. All right, let's move on to the next slide. Filing requirements, basically, in terms of who has to file and what is required to be filed. For federal purposes, U.S. for domestic filing purposes, U.S. citizens and resident alien taxpayers will be filing a Form 1040, which we'll introduce you to shortly. For resident aliens, you're considered a U.S. Income taxpayer if you have a green card or you have passed what is known as a substantial presence test. So we're not going to get into all of those details there, but basically, if you are a U.S. citizen or a resident alien, you'll be filing Form 1040. If you are not considered as such, it's possible that you would be deemed a non-resident alien and you would need to file a different form, namely Form 1040-NR. So if you do not fall into either it being a citizen or a resident alien, then this presentation may not be of any use to you. Now, there are income thresholds that you need to exceed that, if you exceed, would require that you file a federal income tax return. And for 2022, those thresholds are: for single taxpayers under age 65, that threshold is $12,950. Now, that $12,950 is also known as the standard deduction for a single taxpayer. And when we say standard deduction, basically the government, the way the tax code is written, all single taxpayers get a standard deduction of $12,950. And that comes off the top of your income. So if you earned, let's say, $13,950, you would reduce your income by that $12,950, and your taxable income would be $1,000. So the first $12,950 you have no tax on as a single taxpayer. Anything beyond that would be subject to an income tax. For married couples, and single versus married filing jointly are, for the most part, the most common filing statuses. And if you're under age 65, your standard deduction is $25,900. And it's no coincidence that the $25,900 is double the $12,950. So for a married couple filing a joint income tax return, their combined earnings, if they do not exceed $25,900, they would have no income tax liability to worry about. And then there are other filing statuses, which we won't necessarily get into, that being married filing separately. Obviously, if you, in terms of your marital status, for your information, your marital status is deemed, is determined on the last day of the tax year. And for all of us, our tax year is a calendar year, obviously running from January 1st through December 31st. So if you were married before the stroke of midnight on December 31st, you would be considered a married taxpayers and would be able to file as married filing jointly, even though you've only been married for a matter of moments, so to speak. So the determination is your status as of the last day of the tax year. And the same would be considered in terms of not being married. If effectively you were divorced under the state law in which you're in, as of that last day of the year, you would then be single taxpayers at that point in time. So that's something to keep in mind if need be from that standpoint. Now, it's possible that you may have had a part-time job at some point along the way, and it's possible that your employer may have withheld income taxes from that part-time job, and it's possible that that part-time job did not result in you needing to file an income tax return because you didn't exceed the threshold. The question I want to pose to you is this: if, for example, your employer withheld federal and or state income taxes from your pay, the government is not going to send you a refund of those taxes which you are entitled to. So in order to get that refund, even though you did not exceed the threshold for a single taxpayer, let's say, you would need to physically file an income tax return to get that money back. So it's possible maybe within the last few years, you've had a situation where you didn't think you had to file, or someone said you were under the limit and you did not file, but in fact, maybe had federal and state taxes withheld from your pay. You want to go back and file a return. Unfortunately, if it's greater than 3 years, which is the statute of limitations in terms of filing a return, generally, if you were to file a return for tax year beyond that 3-year period, the government is under no obligation to send you that refund, and the government also is under no requirement to assess a tax if in fact you were liable for a tax because you didn't file the return. So keep that in mind. So if there are any situations where you think you may have a few dollars that you have withheld from your paycheck, file that return so that you can get that money back. All right, let's move on to the next slide. All right. With regard, in continuing with regard to your filing requirements, I want to bring this to your attention, and this is known as the kiddie tax. This was implemented a number of years ago to sort of close a loophole, and that loophole being the shifting of income from parents to children. For federal income tax purposes, we are operating under a graduated income tax rate. The beginning tax rate is 10%, and the highest tax rate is 39%. And there have been prior years where the highest tax rate was as great as 70%. But this has all changed. The tax system is a fluent system where it's forever changing. Right now, tax rates are the lowest they've been in a number of years. As I said, rates were as high as 50 and 70% at one point in time on certain types of income. In any event, Congress, in their infinite wisdom, felt that they needed to close this loophole, so to speak, in the sense that if income was shifted to a child in a lower tax rate, there would be savings. So they've implemented what is known as the kiddie tax. Now, the kiddie tax is a tax that is based upon your parents' tax rates, provided you meet certain conditions. So basically, if you need to file in terms of calculating your tax, if it needs to be calculated under the rules of the kiddie tax, there is a separate form that needs to accompany your tax return, and that's Form 8615. So let's go through the conditions here that would require that your income be taxed at your parents' rate as opposed to your rate. So this applies to children under age 18 and certain other children described below with unearned income over $2,300. Now, when we talk about unearned income, we talk about interest, we talk about dividends, we talk about capital gains from the sale of stocks and what have you. And there is another component of income that can come under this, and we will talk about that with regard to maybe a taxable portion of your financial aid that you're receiving from the university, typically referred to as your stipend, but we'll get into that in greater detail. That, for kiddie tax purposes, is considered unearned income. So if you are receiving some taxable financial aid from the university, that may come into play. So let's go on to the conditions that have to be met. In all of, as you can see, all of the following conditions must be met. The child had more than $2,300 of unearned income. The child is required to file a tax return. And under 3, the child either was under the age of 18 at the end of 2022, or the child was age 18 at the end of 2022 and did not have earned income that was more than half of the child's support. Now, what we're talking about here is basically, when we talk about the child's support, either the child is self-sufficient in earning sufficient earned income, such as salaries and wages, to support him or herself, or if the child is not have sufficient earned income to support his or herself, then obviously that support is coming from someone else, and that's typically coming from a child's parents. So, and when we talk about support, what we're talking about is what it takes for one to support his or herself during the course of the year. There is plenty of information that you can refer to with regard to one's support, that being food, clothing, shelter, it's medical expenses, et cetera, et cetera. So I'm not going to get into the details with regard to what makes up one's support. You certainly can look into how the IRS measures that, so to speak. And if you have earned income, salaries and wages greater than 1/2 of your support, then you don't meet that condition. And the same applies with regard to the following condition, where you were a full-time student at least age 19 and under age 24 at the end of 2022 and didn't have earned income that was more than half of the child support. So, and then finally, we have at least one of the child's parents was alive at the end of 2022. Obviously, if both parents were not alive, then you would meet that condition and the kitty tax doesn't apply. And then lastly, the child doesn't file a joint return. So obviously, if you were married, filing a joint income tax return, the kitty tax does not apply to you. So something to keep in mind. At the end of the day, if the kitty tax applies to you, you have to coordinate the filing of your return with your parents' return, because there is information, excuse me, that you will need from your parents' return in order to complete this particular form. So keep that in mind. And if it does apply to you, you need to consider filing this tax form. The tax software that you're using, be it TurboTax or any of the others, is capable of producing this particular tax form for filing with your income tax return. So enough said about that. Keep it in mind. And if it does apply when going through the process of preparing your income tax return, keep that fact in mind. All right, next slide. Just a quick note with regard to, if you're not a resident taxpayer, you're a non-resident taxpayer. And if you are a non-resident taxpayer, you would be filing a Form 1040-NR. And the reporting requirements depends on the individual source of income, if there's any tax treaties that may apply, and so forth. So we're not going to get into that in any great detail, but that's the other side of the coin, so to speak, with regard to if you were considered or deemed to be a non-resident taxpayer. Now, filing options with regard to filing today, everyone, more and more as each year passes, more and more individuals are filing electronically. I certainly encourage it. In terms of filing a paper return, it slows down the process, and there are very, very, very few taxpayers who would be required to file a paper return. So the software, the TurboTax software, and all of the other software that's available out there, including, I've got a link here that basically allows for a free filing through the IRS of your tax return. And as I understand it, if your taxable income is below the $69,000 threshold, there is no fee for the use of that software. So filing electronically obviously speeds up the process. And obviously, if you're entitled to a refund, it's going to speed up the process of you getting your refund more quickly. So I certainly highly encourage you doing that and going through the process of filing an electronic return for both federal and state if you're required to file a state return. As I said earlier, the due dates for filing in Massachusetts for Massachusetts residents filing a mass return and a federal return, it's Tuesday, April 18th. If for any reason you cannot meet that filing deadline, you can request an extension of time to file your return. It's totally automatic, but you do have to file the extension. And if, again, you're using TurboTax or the other software, that software does have the capability of producing that extension form, and you have the ability to file that extension form electronically to extend the due date of the return. Now, by extending the due date of the return, what it does not do is extend the date in which your tax liabilities due in full. April 15th is normal filing date, but given the fact that the 15th, I believe, excuse me, falls on a Sunday. And then there are a couple of holidays that boost it up to Tuesday, the 18th. But in any event, if you owe both either the federal or state government or state governments for that matter, if your tax liability is not paid in full by April 18th this year, you would be subject to penalties and interest for underpayment of your tax. So keep that in mind. The government wants and requires all taxpayers to sort of settle up by the initial due date. And they don't necessarily are concerned about you filing beyond the due date as long as you pay your tax in full by that date. And again, if you don't, you're subject to penalties and interest. If you do ultimately get an extension of time to file your return, you can extend the filing of your return to as late as October 15th of 2023. So, you know, that if you need to, for some reason, you have that option that's available to you. And that's the case in both the for federal filings and for Massachusetts filing. As far as other states, for the most part, pretty much the same dates. If obviously there's a other state return that you need to file, I would check with you know, on the state's website to find out what the exact filing date is. So keep that in mind moving forward. All right, next slide. All right, now, your tax liability is based upon your income and your income that is taxed. As a resident, you were taxed on your worldwide income. So all income from all sources is subject to tax. And the laws behind all of this obviously stem from the Internal Revenue Code, the tax code that we have to follow. And basically, the Internal Revenue Code has a section in it. It's called Section 61. And Section 61 of the U.S. Tax Code basically says that all income from whatever source derived is taxable. So basically, the tax code is starting that everything is taxable. And then fortunately, there are other sections of the code that exclude certain income from being taxable. We're not going to get into that in any great detail, but fortunately, not everything that one receives in the form of income is subject to tax. There are many exclusions that apply. Some of the more general popular amount of income that is to be reported is if you're receiving salaries or wages from an employer, you would get a W-2 form, which we'll introduce you to shortly. So wages that you are receiving would be taxable. It's possible that a portion of your scholarships, fellowships, and grants that you're receiving from the university would be taxable. If you have interest or dividends that you're receiving on investments or savings accounts, that income is taxable. If you're receiving investment income from various investments, partnerships that you might be involved in, that's taxable. If you're receiving royalties and prizes and awards, those amounts are taxable. And then finally, if you're the owner of real estate where there are rentals or sales of real estate, those amounts are taxable as well. So those are sort of the more popular amounts that you know, we encounter and most people report as income on their U.S. income tax returns. So there are other amounts, but I mean, in your case, basically, I think the ones of greatest concern is salaries, any potential taxable fellowships, scholarships, and grants, and maybe some bank and dividend income. All right, next slide. All right, let's talk about fellowships, scholarships, and grants and their taxability. At one point in time, a long time ago, any financial support that any student received was fully tax-free. Unfortunately, as I said earlier, the tax laws are forever changing, and at some point along the way, they changed in that it's possible that some of the financial support you're receiving from the university may in fact be taxable. So let's talk about scholarships and fellowships and so forth. The IRS generally, when you talk about scholarships, scholarships are generally an amount paid or allowed to a student at an educational institution for the purpose of study, whereas fellowships are basically given out for individuals for research purposes. And as I said earlier, whether your scholarship, fellowship, grant, or award, however it's referred to, basically section 61. And as I indicated earlier, there are other sections of the Internal Revenue Code that identify exclusions. So section 61, as I said earlier, is that section of the code where basically all income from whatever source derived is taxable. Fortunately, there's section 117, which talks about gross income. An exclusion in gross income does not include any amount received as a qualified scholarship by an individual who is a candidate for a degree at an educational organization. So basically, we have this section 117 that is going to help us determine what is not taxable in terms of reporting income on our tax returns. So if we can move to the next slide, let's get into the taxability and non-taxability of the financial support that you're receiving from the university. It's non-taxable if the following conditions are met. The individual is a candidate for a degree at an educational institution that maintains a regular faculty and curriculum and normally has a regular enrolled body of students in attendance at the place where it carries on its educational activities. There's no question that Harvard University clearly maintains regular faculty and curriculum. It's clear that you're here to obtain a degree. So that condition is met. The next is and, as you can see, and if the first condition is met, we need to meet the second condition, and that being amounts you receive as a scholarship, fellowship grant are used for tuition and fees required for enrollment or attendance at the educational institution, or for fees, books, supplies, and equipment required for courses at the educational institution. These are known as qualified educational expenses. So if your financial aid and support go towards those types of tuitions and fees and expenses and so on and so forth, then that portion of your financial aid is not taxable. There is, however, a portion of your financial aid for many of you that becomes taxable. And what we're talking about is if you are receiving amounts that are used for incidental expenses such as room and board. Many of you are receiving stipends, an amount which is referred to as a stipend. And basically that stipend is primarily for your living expenses, primarily room and board. If it's used for travel, optional equipment, and generally amounts received as payments for teaching, research, and other services required as a condition of receiving the scholarship or fellowship grant, then it would be taxable. In addition, any part of the scholarship or fellowship that represents a payment for service is taxable as well. So Congress basically decided that they were going to sort of identify certain portions of one's financial aid that have, that basically deal with what they've referred to as incidental expenses, and those amounts are taxable. Now, I want to bring to your attention, there is an IRS publication which you can obtain online, or you can refer to online. It's publication 970, and it talks about what we're discussing here and now. And in fact, it includes a worksheet that you could use to determine the exact amount of your financial aid, your scholarship, fellowship, grants, what have you, that would be taxable for U.S. income tax purposes. So I would suggest that you refer to that publication. Read it a couple of times. When I say the publication, it's not like you're going to read something that's like War and Peace. It's basically a chapter within the publication. It probably consists of about 5 or 6 pages in length, and it just discusses the rules pertaining to the taxation of scholarships and fellowships. So I highly recommend that you refer to it so that you clearly understand what may be excluded in terms of from your income, in terms of what would be taxable versus what is not taxable. All right, let's go to the next slide. And again, we're referring to that worksheet 1-1 to compute your taxable scholarship and fellowship income. Now, basically, the Internal Revenue Service, there are a number of mechanisms in place to sort of keep taxpayers, as I refer to it, honest, so to speak. And what I mean by that is, for example, if you work for an employer and you're receiving a wage or a salary, at the end of the year, your employer will issue you a W-2 form. And the W-2 form is a form which will show you a facsimile of it. A W-2 form basically reflects the amount of income you earned from that employer during the calendar year. And also it reflects the taxes that were withheld from that payment. And you get a copy of the W-2 form so that you can use that in preparing your taxes. And guess who else gets a copy of it? The Internal Revenue Service. So the Internal Revenue Service will, believe it or not, at some point, well after you've filed your income tax return, will compare your income tax return with the W-2 form that you received. And obviously, the government is expecting you to report that income that's reflected on that W-2 form on your tax return. If you don't, what will happen is you'll get a letter from the Internal Revenue Service, and it'll be a simple letter basically indicating that according to our records, you earned salaries and wages that you've not reported on your tax return. And if you agree with our finding, this is what you owe in terms of additional taxes and what have you. So basically, there is that check and balance in place that the government will rely on to sort of keep everybody honest, as I say, basically. There are other documents that are issued that do the same, serve the same purpose. 1099 miscellaneous forms, a form 1042S. And there are situations where no documents are issued, and this situation really comes into play here with regard to that taxable portion of your financial aid that you're receiving. The university is not, all universities are not, they're not under any obligation to inform you on a W-2 form or a 1099 form, how much of your financial aid is taxable. That responsibility is on you. I'm not exactly sure why that is the case, maybe because it varies from individual to individual, frankly, and they may not have enacted some type of check and balance, because at one point in time, like I said, all scholarships and fellowships were not taxable. So the mechanisms was never in place, and for some reason, they just felt that that's not the case. So basically, it's on you to determine what portion of your aid is taxable and to report it on your tax return. Now, at the bottom of the screen, there is a sort of an excerpt of a Form 1040. And this is something that has changed recently in terms of how you report your scholarship and fellowship income. Prior to 2022, your taxable fellowship and scholarship income was reported on line 1 of Form 1040. For 2022, the amount of your taxable scholarship and fellowship grants not reported on your W-2 form are now reported on Form 1040, Schedule 1, line 8R. So it's separate, as before, these taxable amounts were reflected on line 1 of Form 1040. So this is a new approach. The IRS has now created a specific line item on the tax return to report these particular amounts. So keep that in mind. Obviously, if you're using a tax software, the tax software it better be up to date, needless to say, and I'm sure it will be, because I mean, these companies that produce this tax software are quite reputable, and they're certainly on top of, obviously, all of the changes that are taking place in the tax laws from week to week, from year to year, month to month. So basically, that particular line, again, line 8R on Schedule 1 is where you will report your taxable scholarship and fellowship income. All right, let's move on to the next slide. And we'll introduce you to some forms. And here we have page 1 of Form 1040, which you'll be filing. A number of years back, there were multiple 1040 forms. There was a 1040A, a 1040EZ, and they have all been eliminated. There is now one form that is filed by all taxpayers, and here is the front side of that form, Form 1040. And as I said before, in reporting your taxable scholarships and fellowships, that amount was reflected on line 1A of the form with your other income. That has changed. So you're going to now go to Schedule 1 of Form 1040 and reflect that information. Okay. So that's a facsimile of the 1040. And I'm not going to get into line by line. Basically, again, when you're using the tax software, if you accurately enter the appropriate information in the appropriate boxes and respond to the questions accurately, you will get the result you are looking for. So just keep that in mind. All right, let's move on to the next page. One thing I want to bring to your attention is this is page 2 of, this isn't page 2 of the Form 20 for 2022, it's for an earlier version, but basically the point I want to bring to your attention is within the page 2 of the 2022 return, there is a section where you can enter your banking information. And that will allow you to request from the Internal Revenue Service, and it also applies on the Massachusetts return and virtually all other states' returns, the ability to have your refund deposited directly to your bank account. So by filing your return electronically, and by requesting that your refund be deposited directly to your bank account, it's going to speed up the process incredibly. In years past, when we didn't have this feature, it was all generally 6, 8, 10 weeks before you would get your refund. Now, obviously, with the fact that you can file a return electronically and request your deposit to be deposited directly to your bank, refunds are being issued in a week's period of time. So obviously, it's going to speed up the process, needless to say. The other reason why it's helpful is, in terms of, when you file a return, it's possible that you may have left, whether it be on vacation or returned home to another part. Basically, if you were to get a check in the mail, it's going to sit in the mailbox. It's going to get lost. It's going to get stolen. Who knows what's going to happen to it? So I highly recommend that you obviously utilize this feature. And needless to say, make sure that bank account remains open until the time that these refunds are finally reaching you from that standpoint. Otherwise, you're going to go through a long, drawn-out process to try and obtain that refund. If it doesn't hit your bank, the correct, if you don't provide the correct banking information, or for some reason it doesn't get to your bank for some reason. So keep that in mind. All right, next slide. All right, here are a couple of forms that I just sort of want to introduce you to. As you can see, this is a form dated 2016, but basically this is a facsimile of a W-2 form. And on the W-2 form, you have the employer's name, you have the taxpayer employee's name, and then you have a bunch of information on lines 1 through 20 that is consistent on all W-2 forms. A W-2 form, this is one facsimile of one. They come in many shapes, sizes, and colors, but basically the same information is reflected on all W-2 forms, regardless of what they look like. Box 1 is the wage that you've earned, the salary or wage that you've earned. Box 2 reflects the federal income taxes withheld. And then on from there, we have Social Security wages, the taxes withheld, Social Security, Medicare taxes withheld. And then starting in box 15 through 20, you have your state income that you've earned and the state income taxes withheld. So the employer will issue the W-2 form. They should be issued by now. If you've had employment during the course of the year, the W-2 forms should have been issued by the end of January. So if you were expecting to receive one and haven't received one, I would pick up the phone, call your employer, and ask where it is. Maybe they have an old address, whatever the case may be. Maybe your access to it may be through downloading it from their computers or whatever, but you should have received your W-2 by now. Next form is a facsimile of a dividend income form. So if you have monies invested in securities that are paying dividends, you should receive this form 1099 DIV. This is the form that your financial institution or company would have issued to you. And again, that particular form should have been released by now. What we're discovering with regard to these financial institutions, they're taking longer and longer to issue these forms. I have clients to this day are waiting for these statements so that they can file their income tax return. Why they're delayed, I have no idea. It's a complicated process. And I think basically, if they issue these forms sort of prematurely without having what is deemed to be accurate information, then they would have to reissue them again. Needless to say, the cost of doing that for these big financial institutions can be pretty significant. So they wait as long as they can, and unfortunately, it's causing difficulties for many taxpayers waiting on this information. So again, if you're receiving dividends, you should be receiving a 1099 DIV form so that you can report those amounts accurately. The next slide is an interest dividend, an interest form, I'm sorry, Form 1099 INT, which is reporting the interest that you've earned on a bank account, a savings account, a certificate of deposit, what have you, that the financial institution would be issuing to you, like the 1099 DIV. So that will inform you of the correct amount of interest you need to report. As I said earlier, the 1099 DIV, the 1099 INT, the W-2 form, all of these forms are transmitted to the IRS. And if, again, you've earned interest or dividend income that you didn't report, or inadvertently omitted it from your return, then you're going to get a notice from the IRS. Oh, by the way, you forgot to report this. We're going to assess additional income tax on the return. If you agree, please pay this amount, and that's the end of it. You move on. If you disagree with what they're disclosing, then basically you would respond to their notice and provide your sort of side of the story, so to speak, so that you can then hopefully resolve that through correspondence with the IRS. All right, let's move on. All right, now, with regard to, and the reason we're bringing this up is if, for example, you do have taxable scholarship or fellowship income that you have to report, you'll know by now, I would assume you would know by now, that the university is under no obligation to withhold taxes from that amount. So not only are they not disclosing to you in some type of W-2 form or 1099, they're also not withholding taxes from this. So the question is, well, if it's taxable and I have to report it and they're not withholding taxes, what do I have to do? Basically, you're under an obligation to pay what is known as an estimated tax. And in that opening paragraph, the rules are such that for federal and state income tax purposes, all taxpayers who expect to owe $1,000 and $400 respectively are required to pay an estimated tax. So if at the time you prepare your income tax return, if your federal tax liability is $1,000 or more, you should have paid an estimated tax during the course of the year. That's the rule for federal purposes, $1,000. That's the threshold. If your tax liability is under $1,000, you are under no obligation to pay an estimated tax. And all you have to do is pay what you owe by the due date of the return, which is April 15th. For state tax purposes, for Massachusetts purposes specifically, if your tax liability is $400 or more, you would be required to pay an estimated tax during the course of the year. Now, basically, when we talk about estimated taxes, we're essentially saying that on a quarterly basis, we're going to remit 1/4 of your estimated tax. So for example, if your estimated tax, let's say for federal purposes, is $2,000, the IRS would expect to get $500, 4 installments of $500 each. And those installments need to be paid by April 15th of the current tax year, June 15th of the current tax year, September 15th of the current tax year, and then January 15th of the following year to complete that final payment. So if you meet those requirements and you pay on time, what you're not going to be, you will not be penalized for failure to pay an estimated tax. If you don't pay the estimated tax, or if you pay beyond those due dates, then you're going to be subjecting yourself to potential penalties and interest. So you want to keep that in mind. So you need to plan for this and project from a standpoint of what you will potentially owe come this April 15th, for example. Not only are you going to be filing your 2022 income tax return, come April 15th of 2023, you now have to start thinking about whether you have to pay an estimated tax for the 2023 calendar year. So you got two things that you need to address. If you owe any money for 2022, it's got to be paid by April 15th. And if you're going to be receiving some type of taxable financial aid, you need to start planning on paying an estimated tax for the 2023 tax year. So you got a couple of things to keep in mind. Now, with regard to avoiding penalties and interest and so forth, basically there's two safe harbors that you can fall into. In order to avoid penalties for underpaying of your estimated tax, the total of your estimated tax payments for the current year must be greater than 90% of the current year's tax liability or 100% of the prior year's tax liability. So those are the two safe harbors you can fall into to avoid being penalized for not paying or underpaying your estimated taxes. So keep that in mind. Plan ahead. Do some projections, frankly, with regard to, for example, at this point in time, for those who are sort of coming into the university in the fall and are receiving a taxable stipend, you're talking about receiving 4 or 5 months of stipend, which is going to add up to maybe somewhere in the neighborhood of maybe $12, $13, $14, $15,000. If you're single and it adds up to $12,950 or less, you're going to owe no taxes if you have no other income. But obviously next year, if you're a student for the entire year and receiving 12 months worth of stipend, you're probably looking at somewhere in the neighborhood of $30,000 or plus. You are certainly going to have a tax liability. So you need to plan on that. So keep that in mind and plan accordingly. And my suggestion is make sure you pay those estimated tax payments, because the year comes and goes pretty quickly. And if you wait till the end of the year, you're going to be penalized a fair amount of money, or at least money that you shouldn't be wasting in terms of sending to the government, the federal and state government, if that be the case. So plan accordingly, please. Otherwise, you'll be just sort of throwing money out the window. With regard to paying estimated taxes, there are two links there at the bottom of the screen, one for the IRS, one for the state, where you can make these payments electronically. Which I'm sure most of you would be comfortable in doing. If you're uncomfortable in making these payments electronically, you can always send both the federal or the state government a check. And basically that check should be accompanied by a form. For federal purposes, that form is Form 1040-ES. For state purposes, the form is Form 1-ES. And it's basically a transmittal form that's accompanying the payment so that it gets properly identified as your payment. So just keep that in mind. But I suspect many of you, if not all of you, will certainly take advantage of paying the payments electronically. All right, let's move on. All right, next screen, basically just quickly from down here, it's all downhill from here basically, but for the most part, there are educational tax credits that are available presently. There is a tax credit known as the American Opportunity Credit. Why am I bringing this up? Unfortunately, it doesn't apply to graduate students. It applies to undergraduate students, and there's a likelihood that with regard to possibly taking that credit, it's possible that your parents took advantage of this tax credit, I suspect, while you were an undergrad student. So that's out the window. The next credit is what is known as a lifetime learning credit. And basically, the lifetime learning credit is a credit of as much as $2,000 against your tax. So it's like money in the bank. If you can take the credit, the maximum amount, as I said, is $2,000, and it's based upon a percentage of 20% of the first $10,000 of qualified educational expenses that you incur. Now, these qualified educational expenses that you incur have to be the expenses that are not paid for by financial aid that you might be receiving. So it has to be expense out of pocket, basically, on your part. So if you've incurred an out-of-pocket expense of qualified educational expenses of $10,000, then you would be entitled to the credit. So if you're being fully, if your scholarship is addressing your qualified educational expenses in full, then this credit is not available to you. It's only if it comes out of your pocket from that standpoint. And the credit is in the final sections there. It phases out. I suspect none of you are going to be worried about that in terms of your income. If you're a single taxpayer and your income is $90,000 or more, then you're not entitled to the credit. If you're a married couple and your income is $180,000 or more, you're not entitled to the credit as well. All right, next slide. If you've incurred loans with regard to paying any educational expenses, whether it be undergrad or graduate school, you have the ability to deduct any interest that you're paying on your student loans up to $2,500 of interest paid during the calendar year. So if you've incurred interest expense on any loans that were for qualified educational expenses, that will be deductible for you on Form 1040. Like the educational tax credits, the deduction gets phased out. If you're a single taxpayer and your income is $85,000 or more, you have the deduction for the interest expense is phased out entirely. If you're married, filing a joint return and your income is greater than $175,000, then any interest deduction would be phased out entirely. So keep that in mind. Next slide. Let's talk about Massachusetts tax filings in terms of your responsibility there. For Massachusetts state income tax, you are deemed a full year resident if you maintain a permanent place of abode in Massachusetts and you spend more than 183 days of the taxable year in Massachusetts. So basically, you would be deemed a full year resident of Massachusetts. And that's contingent upon maintaining a permanent place of abode, which we'll talk about momentarily. If the above test is not met, generally you would be considered a non-resident for mass income tax purposes. Now, if you have income that is Massachusetts source income, then it's possible you're either going to file a resident return or a non-resident return, depending upon whether you maintain a permanent place of abode in Massachusetts. And for example, if you earn less than $8,000 as a single taxpayer, then you're exempt from tax under Massachusetts law. So if that's the case, then you wouldn't owe any tax liability from that standpoint. So in using the tax software, again, whether it be TurboTax or any of the others, you're going to go through the process of determining whether you have to file a Massachusetts return or not. So keep that in mind. You can certainly rely on the tax software to assist you in determining whether you will be responsible for filing a state income tax return, whether it be Massachusetts or any other state for that matter. It's possible that many of you may possibly be sort of coming from one part of the country into Massachusetts and maybe have earnings in other states. Again, the software is invaluable with regard to helping you determine whether you need to file, whether it be another state return, whether it be resident or non-resident, and for Massachusetts purposes as well. So, as I said, you can depend on the software to help you in that respect. All right, next slide. Sorry about that. All right, now with regard to continue with regard to mass filings. When we talk about permanent place of abode, depends upon the type of housing. So if, for example, you're in off-campus or non-affiliated housing with Harvard, you may be deemed to have a permanent place of abode in Massachusetts. If you're in campus housing or Harvard affiliated housing, then you're considered to be in a dormitory space, and you would not be considered as having a permanent place of abode in Massachusetts, and therefore you would not be a Massachusetts resident and likely would not have to file a Massachusetts return. Now, if you're still financially supported by your parents, it's possible that you would be considered a resident of your parents' state. And it would be possible that you may have to file a state income tax return in the state in which your parents reside, all right? So unless you're a U.S. citizen student providing more than one half of his or her own financial support, it's likely that your parents would be considered as a dependent. You would be considered as a dependent and not necessarily have to file a return. So these are all things that you have to keep in mind. But again, I would rely primarily on the tax software to help you in that respect. One note here is with regard to this Form 1099-HC, which many of you may have received as a result of needing to have health insurance. Basically, that form in Massachusetts, if you're considered to be a resident of Massachusetts, you have to have health insurance coverage. That form provides evidence to the fact that you do have coverage. And although the form does not have to be attached to the return, it's something you need to hold on to provide proof of the fact that you do have health coverage if you're a resident of Massachusetts. All right, next slide, and we'll get to our Q&A as quickly as possible. For example, as I mentioned earlier, if you worked or were a student in one other state, say California or Massachusetts, it's possible that you may have to file two state returns, one for California in my example, one for Massachusetts, and it'll all depend on whether you would be deemed a resident in one or the other. It's possible that you would be considered a part-year resident in both states. It would have to file two separate returns. For example, if you were in California and you had California source income, then you would potentially have to file, whether it be a resident or a non-resident state return in California. And the same would apply in Massachusetts in terms of whether you would be considered a resident or non-resident. So again, as I've said before, and I'll say again, what you want to do is begin to rely on the tax software to get you through the process. So with that, let's put an end to this discussion and let's get to the chat questions, which are many. So let's begin and we'll get through those. And I'm sure there's probably some duplicates along the way, but we'll get through as many of those. We'll go through them all if need be.
Thanks, Bob. Yeah, let's jump right in. So first of all, first question, who do I need to file? For a single person making less than $12,950, do I need to file? Should they file, Bob?
If their income is under that threshold, whether it be married, single or married filing jointly, they would not be required to file a federal income tax return. The only reason they would file is if they had some type of withholding from that income that they would be entitled to. Because if they don't file an income tax return, the government's not going to send that withholding back to them. And what I mean by withholding, I'm referring specifically to federal income tax withholding. If you worked and had Social Security and Medicare withheld from your pay, you are not entitled to a refund of that money, only federal income tax.
Great. Okay. So students that are on stipend income, receiving fellowship stipend income, they don't get a W-2. W-2s are issued for students that are earning income from work. Is that correct, Bob?
That's correct. I mean, it's possible, it's likely that many of the students will at some point, maybe not initially, but at some point be earning a wage in terms of maybe being a teaching assistant or what have you, and will be getting a W-2 from the university for those services. No question.
So how would a student know how much to file on their taxes if they don't receive a W-2 from the university?
All right. Again, if they're receiving a scholarship or fellowship amount, basically what they should do is go through the process. I would refer to that publication, the IRS publication 970, and utilize that worksheet. Now, basically, for the most part, 100% or slightly under 100%, if a student is receiving a domestic stipend from the university, in a monthly stipend, and that, as I've often referred to it, it's sort of discretionary from a standpoint of what those funds are used for. But primarily that stipend, as I understand it, is available to the student to primarily take care of, help underwrite and support their financial, their living expenses. Whether they use it for that particular purpose or go out and buy a new car with it, it really doesn't matter. It's discretionary and they can do whatever they please with it. And that stipend amount is generally what they're going to report as their taxable scholarship or fellowship in any given year. Now, that amount, as I understand it, the students have the ability to go online and get what I refer to as a pay stub.
Mm-hmm. Yep. In PeopleSoft.
Yeah, and that through the PeopleSoft, that particular document is invaluable with regard to identifying, because I've seen them. I've seen those documents that can be printed out. It's invaluable in terms of identifying what would be 100% of what they have to report as their taxable fellowship and scholarship. So that's the beginning point. Now, there may be other amounts that they're receiving that would add to that. And that's where I'm referring individuals to that worksheet in publication 970. It goes through the process thoroughly, and it will result in an accurate amount that one has to report. But 99% of what they're reporting is that monthly stipend they're receiving.
Great. Okay. So one person asked, quote, so to be clear from the beginning, overall, we're supposed to deduct $12,950 from our total income from the year, or do we put down our full income? How does the tax form work, Bob?
Well, I mean, what you have to do basically, like I and many other people have when I first started working, is you roll up your sleeves and you become familiar with your responsibility of filing an income tax return. Back when I started working, there were no computers. We were basically doing it manually. But the bottom line is this: you need to utilize some type of software. And from a mechanical process, the software is going to ask you to enter in your income, whether it be from a wages or whether it be a taxable stipend. That's the starting point. So you're going to enter in your gross income, as it's referred to, and then during the process, the tax software, if you're a single taxpayer, is going to deduct from that income that standard deduction. In the case of a single taxpayer, it's going to be $12,950. So to make the math easier, let's say, for example, someone has to report $32,950, they're going to get a deduction of $12,950, and they're going to be taxed on the remaining $20,000. So the process is you report your gross income on the tax return, and then the $12,950 deduction comes later in the process.
Okay, great. A lot of questions about where do I file multi-state residence? I'm a first-year student coming from out of state. How do I know which state's income tax rules apply to me? Now, we had a slide about, was it 186 days, was it, Bob?
183.
183. So if
Well,
you're
basically, if, for example, that individual coming in from another state, the key question here is this: if you have income that you earned while you were in that state, then you would have some responsibility possibly to file an income tax return with that state. It may be a resident income tax return. It may be a non-resident return. And then the same would apply in Massachusetts. If you have Massachusetts source income, then there's a likelihood that you're going to have to file a Massachusetts return. Whether it's a resident return or non-resident return will be predicated on the rules with regard to determining one's residency. And as I stated, what you need to do is I would rely heavily on the use of the tax software to come to that conclusion for you.
great. Student worked remotely for a company in another state while living in Massachusetts. Does he need to file in 2 states?
I'm sorry, I missed the first part of that.
Student was working remotely for a company in another state while living in Massachusetts. How should that student file?
That's a good question. Obviously, we're dealing with that with regard to a lot of individuals working remotely, for other companies. The question here is, it depends, and it depends on how that particular state is treating remote workers. And a lot of that's going to be contingent upon if you're an employee, for example, if you're physically in Massachusetts and you're an employee of a company that's in another state, you're going to get a W-2 form from that employer. And the key to answering that question has to do with how that employer treated those wages. If you could go back to the W-2 form, I'm not sure what slide it is. Hold on a minute. It's slide number 12. You can go back to that slide. There is a W-2 form. Now, that individual is going to get a W-2 form from that employer. In box 15, as you can see on this facsimile of a W-2, the state is going to be identified. So, for example, if that company was a California company, it's going to identify whether they've withheld California income tax or another state's income tax, Massachusetts income tax. If, for example, that individual's W-2 form says CA, then what they're doing, their reporting is they're indicating that those wages are California wages, and they would have to file a California return.
Okay, great. Let's move on to a number of questions about, first, can you again define for us what is taxable fellowship or scholarship? Because there seems to be some confusion about that.
Well, basically, in a nutshell, yeah, here is the slide here, slide 8. Basically, if, for example, the financial aid you received, there's no question you're all receiving degrees, candidates for degrees. So we've met that condition. The second condition basically states that amounts you receive as scholarship or fellowship grants are used for tuition and fees required for enrollment. So a good portion of your scholarship or fellowship will be applied to the tuition and fees that are required for enrollment. Those amounts that you're receiving would be non-taxable. In addition to that, if you've again used your fellowship, scholarship or fellowship for fees, books, supplies, and other equipment required for courses of education at the institution, those amounts would be non-taxable. Again, what individuals have to do is they need to, again, refer to that IRS publication. In the IRS publication, you can get, if you go to irs.gov and then do a search, publication 970, it will come up on your screen and you can produce, the particular publication 970 addresses a number of situations. The very first chapter in publication 970 addresses the taxability of scholarships and fellowships. So I would highly recommend that the student go to that publication, read again the 5 or 6 pages that are dealing with the taxability of scholarships and fellowships, and utilize the worksheet to arrive at what would be deemed taxable. There's no better place to begin than there. That's where they need to start, and that's where they're going to end. And the fact of the matter is, if, for example, the IRS, and in all the years that I've been doing this, if the IRS were to question what you're reporting as taxable, or questioning what you feel is non-taxable, the worksheet that you would prepare out of that publication 970 is, in essence, your supporting documentation to arrive at what you deem to be taxable. That's basically what you're going to show the Internal Revenue Service if they question that amount. And then obviously, you've come to some conclusion as to what's taxable and non-taxable, and you have the documentation behind it to support your conclusion. Whether your conclusion's right or wrong, that's for another day. But basically, this is the documentation that you're going to present to, support your argument. The next question is whether the agent agrees or disagrees with your findings and conclusions. But if you go through the process, that worksheet's going to be extremely helpful for you to arrive at the correct response.
Great, thank you. We're running out of time. Real quickly, medical reimbursements that are paid to a student from the Harvard Graduate Student Union, are they taxable? How does one list that on their return?
Medical reimbursements?
Correct.
That's the first I've heard of that. What's that all about?
Well, a student can request funding from the Harvard Graduate Student Union if they have out-of-pocket medical expenses, is my understanding.
That's the first I've heard of it, to be honest with you.
So if it's money that's paid to a student, whether it's for for services or a stipend, if it's money paid to somebody, that is taxable?
Potentially would be, yes, I would say so.
Okay.
I would say so. And again, go through the exercise with regard to that worksheet.
Okay, great. Regarding estimated taxes, what if you don't know what your estimated income or scholarship will be in any given year? Where does a student start off with paying quarterly taxes if they don't know?
Well, I mean, basically what they have to do is, sort of simulate what their tax liability is going to be, what their income is going to be. They can't be ignorant of it, for example. And like I said earlier, for those students coming in the fall, they're receiving, and someone correct me if I'm wrong, if they're receiving a monthly stipend, they're getting, I think, about 5 months worth of stipend.
It could be.
Okay, in that neighborhood, let's say, for example, and if it's $3,000 a month, you're talking about $3,000 a month roughly, you're talking about $15,000. And if they're a single taxpayer, they're going to get the $12,950 deduction, and they're going to have taxable income of roughly $2,150. Now,
So they should just estimate to the best of their ability. But if they don't know what their income is going to be and they underestimate, are there negative ramifications for that?
well, I mean, if someone, like, again, if someone coming in the fall here is getting $3,000 a month for the last 5 months of 2022, their stipend is going to continue into the new year, right? And it's going to continue for a period of 12 months.
Mhm.
And for a period of 12 months times 3,000 a month is $36,000 a year. That's where they're going to begin. That's the starting point, and they're basically going to sort of do a projection of their tax liability based upon that information.
Okay, great.
So they're going to do a projection, which is essentially going to, result in them seeing that they're going to owe a tax for the 2023 tax year, and they need to begin paying an estimated tax based on that projection.
Okay. All right. I think we're at time. There were a few questions that we didn't get to. But if you have questions, you can email Robert Underwood. Here's his email address, runder@rcn.com. Please feel free to reach out to him.
Yeah, absolutely. Absolutely. Please do.
All right. Thank you so much, Bob. This has been really great. It's always good to have you here.
All right. Thank you, Lisa. Thank you, Rachel. Thanks again. I appreciate it.
Thanks, everyone.
Thanks, Bob.
Have a good night.
All right. Good night, all.